Good morning. My name is Frank Fantozzi, President and founder of Return on Life Wealth Partners, and welcome to Frank Wealth Insights. Today, we're diving into one big, beautiful bill, affectionately known as the Big Beautiful Bill. This is a major tax legislation that has sweeping impact on individuals and small businesses, with some provisions that are game changers and others that come with a ticking time clock. Today, I'm glad to be joined by our new teammate and tax service manager, Tom Reyolds, a fellow CPA who has tons of experience guiding individuals, families, and business owners through the ever-changing tax code. Before we begin, though, I have to remind everyone that this podcast is for general information and educational purposes and does not provide specific financial, legal, or tax advice. Please consult your own qualified professionals before making any financial decisions. Hey, Tom, thanks for joining us today. We got a lot to cover, but I'm going to turn it over to you and at least start out at a high level. What are the most impactful changes for individuals and families? Kind of what's the big overarching purpose of the Big Beautiful Bill?
Well, thanks for having me, Frank.
Sure.
Happy to be here to talk about this new exciting tax law. It was signed into law by the President on July 4th, 2025, Independence Day. And it has a lot of changes that are significant and impactful for this year and future years. For small businesses, families, a lot of individual credits and deduction changes, as well as opportunities for savings. So the Tax Cuts and Jobs Act, which was passed in late 2017, going into effect in 2018, a lot of those provisions were over with or not going to be extended or done with after this year.
So they're going to expire at the end of this year.
So the Big Beautiful Bill made many of those permanent and also extended some of those changes. So it was very important and it was significant because it was done mid-year and it impacts 2025, where historically tax law changes a lot of times are at the very end of the calendar year and only impact future years.
Yeah, so more prospective than retro.
Right. So a lot of folks don't realize about these changes. So our discussion today is very timely because it impacts this year and future years, not just future years. So that's a lot of planning opportunities for businesses and individuals this year right now.
All right, so people got to get on the stick and make sure that they don't pass on some important planning opportunities.
Correct, yes.
So why don't we start with, at a high level, what's happening with the tax brackets, standard deductions, credits? Is there anything going on there? I mean, that's kind of where I think the fat of everything is at, where people are worried about, okay, are there changes to my tax bracket? And, what do I get to deduct? Things like that.
So let's start with the things that were made permanent.
Okay.
So the Tax Cuts and Jobs Act passed at the end of 2017 has significant changes in tax reductions.
Okay.
Well, a lot of those changes set to expire were now made permanent. The lower tax brackets with a 37% top rate stay. Another thing that's going to impact almost all individual taxpayers that file taxes is a higher standard deduction.
Oh, that's music to people's ears.
Yeah, absolutely. So almost $16,000 for single and $31,500 approximately for joint filers, married filing jointly. Plus, depending on the age and blindness, there's an additional amount that they can be added on to the standard deduction.
Okay, so I saw a lot of criticism that the bill was just for the, super wealthy, all the breaks for the super wealthy. But some of these that you're talking about right now are really helping, middle America or lower income families by raising the standard deduction and putting in increased credits and things like that.
Absolutely. Great point. This was a comprehensive bill that impacts almost all taxpayers and almost all businesses. So we're going to get into a lot of the things that impact everyday folks, hardworking folks, and many of them, hopefully they'll watch this discussion, many of them they don't know may impact them or may have some misunderstandings about what they heard. So I'm excited to talk about it.
Cool. So any changes to our retirement accounts, savings, and things like that? I mean, what's happening with improving our ability as individuals to save towards our own retirement? Has there been any changes in that area?
Yeah, so there's some important, exciting changes with that. So there's higher contribution limits for 401ks and IRAs. They increase them for inflation so people can get tax benefits at pre-tax and post-tax for putting more into their retirement for the future. There's expanded opportunity for Roth IRA conversions, and this is a very important tax planning matter. Depending on people's individual income and their situation, it may make sense for them to work closely with their finance and tax professionals to convert a pre-tax retirement account to tax shelter that and convert it into a Roth account to protect it from future taxation based on their income and what they can afford this year. So a great opportunity there.
Yeah, so for individuals looking at that decision, so I put pre-tax money with the whole idea that, traditionally when I retire, if I'm in a lower tax bracket, I'll benefit by using a pre-tax account, or what we call a traditional 401k plan or a traditional IRA, where now, one of the advantages is depending on where your tax bracket's going to land or where your estate planning is going to take you, the Roth might provide a different type of benefit where you don't get the upfront tax deduction, but having that accumulation and distribution coming out tax-free can be more important in their planning.
Yeah, absolutely. And especially if future tax rates are likely to be higher, which that is a possibility. We don't know that for sure, but that is possible. So, wanting to protect as much future retirement distribution and tax-free growth in your retirement investments are key. It's a game changer for retirees.
All right, that's awesome. That's awesome. So, what's new with some of the tax credits and some of the new deductions? What's kind of new that we haven't seen before? Because they were talking about tip income. That was a big debate. Auto interest. Overtime. What's changed in that area? Because that seemed to be like a new area that the president was focusing in on. Did that all make it into the big, beautiful bill, and how does that work?
Yeah, so a lot of it did. So thank you for asking. So a couple of big things is basically the deduction for tip income. Depending on the taxpayer's income, how much they earn that year, there's no tax on tips to a certain amount if they're under certain income limits. There's phase outs and exclusions for higher income folks, but a lot of hardworking folks that rely on tip income, servers, bartenders, and various other service professionals, they're going to save money on taxes. So that's really going to help them this year. And that's going to be something that not everyone realizes, I don't think.
Yeah. Well, it's not like in Europe where the servers there are paid, kind of what they call a living wage. It's, really tip in Europe. But in the United States, people aren't usually paid a living wage just to be a server or a bartender. So they do rely heavily on their tip income to make it.
And another aspect of it that's really going to help people is no tax on overtime up to a certain limit. So a lot of hardworking people really rely on overtime wages for their income they need to live on. So up to a certain amount of income per year, depending on how much the individual makes, no tax on overtime. Again, that's going to potentially save a lot of taxpayers a couple $1,000s on their federal tax, which is key.
Yeah, so the really goal here with these provisions is to really help the lower income and middle class individuals keep more of what they're making and not make it subject to income taxation.
Absolutely, and this is a significant and new change for this country. So I'm excited to see how the positive impact is on moving forward.
Awesome. So what about the? I know the one provision from the 2017 legislation was the SALT cap, especially people on the East and West Coast who have, we complain about property taxes here in the Midwest, but the East and West Coast have it worse. And there was a total cap on your state and local taxes, including property taxes. It was all capped at $10,000. So there's supposed to be some type of compromise in this bill.
Yes, so there was a lot of back and forth between the House and the Senate.
Yeah.
And in this bill, an exciting provision, especially for folks that pay a significant amount of property tax with their home, they're able to deduct up to $40,000 of state and local tax if they itemize on their return. That's going to result in more people being able to deduct more and more people being able to itemize. So this was an item that people really wanted, and the limit the 10,000 limit on the previous tax law was one of the most unpopular portions of the Tax Cuts and Jobs Act from 2017.
Sure, I know I wasn't happy about it.
This really addresses that. And makes the limit $40,000. Again, there is provisions on high income earners. There's phase outs and limits on that. So this new law only goes to 2030. And then it expires after that at this point. But this was definitely something people wanted.
Okay. What is the phase out cap for the state and local?
Yeah, so it's up if you make over $500,000, it starts phasing out.
Okay.
Yeah.
So again, to address the issue, again, there's provisions for that everyone benefits from, but I think a lot of the legislation we've talked about so far is really trying to put more money in the middle and lower income classes by providing more deductions, more credits, and taxing less of their income.
Yeah, absolutely. And this is only for people who have enough to itemize.
Right.
So that's something that folks will want to work with their finance and tax professionals to see if the standard deduction is more advantageous, or with these significant opportunities for increased deductions, if they would benefit more by itemizing.
Right. Well, I remember from the original bill, the 2000 Jobs Act, it really reduced the number of people that actually itemize. I think it went up to like 60% of the people now don't have to itemize, which made tax preparation, easier. And, you didn't have to really track all those deductions that you would put on Schedule A. Yeah,
so this is going to change that. There's going to be more opportunities for more people to itemize than 2024 and before.
Okay, interesting, cool. Any other provisions that we should be made aware of at the federal level from an income tax standpoint, either from taxes, credits? I knew there was a new thing called a Trump account. You want to expand on that?
So this is an exciting new thing. So for people that have a new child born between 2025 and 2028,
family planning,
they have an opportunity to open up a new investment account for that child. The federal government will provide $1,000 towards that.
Wow.
Individuals can contribute another $4,000 for a max of $5,000 per year. And also employers can contribute $2,500 for that for a year. So there's an opportunity to really invest for your children on an early age, get them started.
And how long can you make these deposits into this account? Is there an age limit or?
Yeah, as long as they're a minor.
Okay, wow.
So this is an ongoing thing, and I think it's a really way to get your children's nest egg started.
Yeah, time value of money. What is it?
Einstein,
thank you. Yeah, the theory of relativity. He said, one of the great miracles was the compound value of money in that formula. So, that will allow, I think, starting at age 1 or when they're birthed, to really put money away and have that money grow in an exponential manner for them.
Yes, and it's a tax advantage account, so similar to a traditional IRA.
Okay. Now, when the money comes out, does it get taxed?
Yes.
Okay.
Yeah.
So it works just like an IRA?
Yes.
Okay. Cool. And it can be used for anything. There's no limitations. It's, like 529 plans, you have to use it for, education and supplies. Here, this money is just a regular savings account.
Correct. It's an investment account.
Okay, great. Any changes at the state level? I know we were talking earlier, we were all focused at the federal level, but I know that at least for people that are in the state of Ohio, there were a lot of changes that went down. So you want to cover that a few minutes?
Yeah, so there's some really exciting changes in the state of Ohio. So Governor DeWine passed the state budget at the end of last June 2025.
Okay.
And the state does a 2-year budget. Well, part of that were some pretty big changes to the state income tax in Ohio, lowering the tax rate. So in 2025, for income over $100,000, the tax rate was lowered to 3 and 1.5%.
Wow.
And in 2026, it's going to be lowered for all income over $26,500. It's going to be lowered to 2.75%.
Yeah, that's pretty significant. I mean, you think about all people that make money over roughly 26.5. That's a big drop in their income tax bill.
Absolutely. So a couple percent decrease on the state tax, and they reduced the number of brackets.
Okay.
So we used to have a more progressive system, which for state tax, the more you made, the more you paid.
Right.
They simplified that and made it more of a flat tax system.
Okay, cool. That works. I mean, hopefully people will embrace it and look at it as a positive. I mean, I know the little controversy was, especially at the federal government. I get reminded when I come downtown to Cleveland, there's a big sign that talks about our national debt at almost $38 trillion, and the whole controversy of, well, how do we keep giving tax breaks and reduce our federal deficit at the same time? So I think part of it, and I don't know if you want to add to it, we're deviating a little, but the whole thing with the whole tariff, I mean, I think part of his balancing act here, or the administration's balancing act, was they're counting on enough of the tariff to basically underwrite some of these tax cuts.
That's exactly right. So additional revenue, which has been significant so far already in tariffs, as well as some significant cuts were made to the federal budget, some controversial, as well as the other thing, which is hard to measure, but they're due estimates on, is the additional economic growth that these tax cuts, especially for small business, incentivize. So they're counting on some of that as well.
Yeah, more activity. Well, you gave us a good lead in, and unless there's something else you want to cover on the individual side,
no, go ahead.
You want to talk about small business and the provisions there, because I think it's really important that everyone focuses on individuals, but if we're not employed, if the economy is not healthy, tax changes doesn't really help a lot. So the fact that I think they combined individual reductions and credits and also moved that to the small business area, I think is significant as well. So why don't we touch on what was made permanent? Because I know there were some provisions from the original Jobs Act that were supposed to expire, and now they made permanent. So why don't you enlighten us on some of those?
Yeah, so a couple of the significant expensing tools or deduction tools for small businesses were made permanent. There's something called the 179 deduction, where for equipment and vehicles and certain other business assets, instead of being depreciated over several years, it can be expensed right away.
All right.
So up to certain limits, it was about doubled, where depending on the business's income, they can 179 expense up to $2.5 million a year.
Yeah.
So that's an incentive for small businesses to really reinvest in themselves and expand.
Retool and get modern and not have to wait for that deduction. They can get the write-off right away.
Right. So it's an incentivize. It's really to stimulate economic growth for small businesses, which is a major sector of the economy. Millions of jobs in small businesses.
Yeah. Well, I think that ties in with the administration's goal to make America great, where they're, focusing in on, how do we improve manufacturing in this country? I mean, when you think about it, manufacturing was really being outsourced for many, many years, to the point where, it became a risk for our country to be dependent on other countries. So to really make it easier for companies to spend money, locate here, I think it's a step in the right direction. So there's policy, it's not just coming up with these deductions and credits. There's a method to their madness, whether you agree with it or not, to incentivize certain things to happen within the United States.
Right, and there was additional deductions and credits specifically for that. To encourage domestic manufacturing, more reshoring, more expansion of our current manufacturing sector. There was an expanded research and experimentation expensing.
Yeah, when did that change? I always used to remember it as R&D. Now it's called R&E.
Oh, they're typically they like to change the technical accounting language every few years. But yes,
it keeps you employed, right?
That's right. It's R&D there. And again, there's some additional deductions and credits to encourage U.S.-based manufacturing. On another exciting provision that ties into this is on the individual side. If people buy a new car and finance it, they take a loan out, and it's a U.S.-made vehicle, they can now deduct their car loan interest.
Wow, that's a big change.
Right, so it'll help U.S.-made manufacturing, more car sales, because there's an incentive for people to be able to deduct the interest.
If they're financing it and they're saying, hey, that's a factor in their buying decision. Like, hey, I want to buy a car. I'm looking at two cars. This one's United States, and it's manufactured well, I think the wording's always a little different, but pretty much primarily assembled and made in the United States, because parts are sourced all over the world. But if it's assembled here and they buy it here, the interest can be deducted.
Yep, absolutely.
So, hey, why don't we cover the QBI, the 198 deduction, because I think that's really important, because most small business owners, they're not incorporated as what they call a C corporation. Most are S corporations or partnerships. How does that kind of level the playing field? Because the original Jobs Act lowered the corporate income tax, but didn't really make major changes to the individual income tax, because as an S corporation and a partnership, that income isn't taxed at the company level. It's passed through the owners, and then the owners are usually paying at the higher bracket, 32 or 37%. Yep. So how does that help levelize the playing field?
So the QBI 199A deduction helped level the playing field by providing a 20% tax break to those pass-through entities that are small businesses.
Okay.
And that was a very popular provision of the Tax Cuts and Jobs Act. Now that is now made permanent with the big, beautiful bill.
Okay.
So a permanent, ongoing, significant tax deduction for small businesses. This was a popular change.
Yeah, well, I think it became, when you look at business formation, running a corporation is just much more complex from a standpoint that small business owners chose S corporations and partnerships, which are easier to start and operate and manage. So I think that was a good thing. Awesome. What are things that we want to chat on that you think are important outside of personal and business tax relief? Is there anything out that you feel that the bill touched on that we should, discuss?
One thing I want to go back to on the individual side is an additional deduction for senior citizens, people age 65 and older, additional deduction of up to $6,000. Dollars.
And just for being 65 and over.
Absolutely. So that's really going to help seniors to reduce the amount of tax they pay.
Yeah.
It also opens up an opportunity for certain seniors, depending on their situation, to do Roth conversions. Maybe they are be able to change the amount of retirement disbursements they're having, as well as some seniors, depending on their income, with the raised standard deduction plus the additional $6,000 deduction, they may or may not have to file taxes. Yeah. So that's something that they need to talk to their tax and financial professionals about. So a lot of benefits to senior citizens.
Yeah, getting older can't all be that bad. Anything expiring out of the bill with the changes? Because I knew originally under the Biden administration there was a lot of credits for EV, solar, and all that. Is that staying in place? Is that getting phased out, or?
Yeah, very good question. So a lot of those green energy credits are phasing out or stopping at the end of this year. Okay. The electric vehicle credit, for example, up to $7,500 exists after this year no longer.
Okay.
And there's been changes the last several years phasing out the home energy efficiency credits, limiting the scope of what people can deduct. So those common ones are going away.
Okay, at the end of 2025.
Yes, correct.
Okay. Right. So again, a lot of planning. If people are looking at spending money on energy efficiency and all that, accelerated in this year if you're thinking about doing it next year, because that's going to be no longer.
Correct. Or if they plan to buy an electric vehicle and want to get that $7,500 credit, this is the year to do it because it goes away in 2026.
Okay. So, one of the big takeaways is a lot of these changes come with expiration dates. And, some of the old rules are going to be, are what they call sunsetting. And then some of the rules are made permanent, which are great. But, one of the, I think, the takeaways is the listeners today need to really focus on what are their initiatives, where are they going to be spending money, where they're going to be from an income standpoint, and kind of make some decisions that impact 2025. This is not let's look forward and see what happens in 26. It's like taking action today.
Right, and you don't want to be too late.
Yeah.
Because some people who don't do tax planning, which we encourage them to do, start thinking about taxes when they have to file them.
Right.
And early 2026 for 2025. Yeah. Well, that will be too late for some of these deductions. So tax plan and credits, which are expiring. So folks really need to start planning and talking to their finance and tax professionals now before it's too late next year.
Amen. I mean, I think we see that all the time. People wait they file their tax returns. Well, what can I do? And like, well, wait a minute. You've already memorialized everything in, if we're looking at filing a return in 2026 for the 2025 tax year, people are looking, what you're saying, and I see it all the time. When they come in and bring in their stuff, their box of information, oh, what planning can I do? It's like, well, wait a minute. Whatever you've done, you've cemented. There's not much you can do after the tax year. So to your point, get on the horse now, figure out what you want to do, figure out what planning could impact you, and look at it from this year if you want to impact the outcome for 2025.
Absolutely. That can be some of the most valuable planning, tax and financial planning. And I love to help people with taxes year round. It's not just tax
season. I see how
season.
you glow when you start talking about taxes. So you're definitely the tax man.
Yeah, so we love to help, and I personally love to help people year-round. Tax season for me is 12 months.
Yeah, that's great. Any other deadlines that we need to remind the listeners today to focus in on, or maybe just cover again, just to make sure people understand that some things are going away this year, some things are going away in a couple years, and some things are permanent. So
yeah, I want to mention a couple things, small business wise.
Sure.
And there's been a lot of controversy and misunderstanding about 1099s and 1099 limits. So if you're a contractor and now get paid over $600, you should be receiving a 1099 NEC.
Yeah.
So that limit is actually increasing to $2,000 beginning in 2026.
Okay.
So that's important for people, for taxpayers to realize that if they're an individual and they did contract work, consulting work, we're not employee. This year, if it's 600 or more, 2025, they'll be getting a 1099, and the IRS gets a copy of those as well.
Right.
So that information needs to go on your tax return.
Right.
That limit is increasing to $2,000 in 2026, but it's also important for businesses to know this as well, because they have to issue or generate the 1099.
Right. There's a liability to them, to a requirement. But even if you don't receive 1099, technically, if you earn income, you need to report it regardless.
Absolutely.
Correct?
Yes, unless it's
I think that's always a misunderstanding. I didn't get a 1099. I don't have to report my income.
Yes, income is taxable unless it's specifically excluded in the tax code.
Okay.
And most income is not. So if you're a small business owner, you need to keep track of your income and expenses and make sure to include those accurately on your tax returns, whether you receive tax forms or not.
Right. Good sage advice. Anything else you want to touch on before we wrap up?
Yeah, so there's something called a 1099K. And with more and more people selling online, online stores, e-commerce, if they sell a certain dollar amount of transactions, they will be getting a 1099K is important as well. The businesses will be. So payees who are paid $20,000 a year or more from online sales should be getting 1099Ks or have over 200 more transactions. That is an increase compared to before.
So that's a great point. Let's talk about that, because I think there's a lot of confusion, because you got Facebook Marketplace, you got eBay, all these places are people are trying to get, basically what I call an online, garage sale. Yes. And so how does that work? If I, have some old patio furniture and I sell it for, $1,000, does that mean I have to report that income? And do I take expenses against that, or how does that work? What should people really do? Whether they choose to follow our advice or not, it's a whole nother story. But how does that supposed to work?
Yeah, great question. So with the expansion of e-commerce, this is a very good question. So to answer your question, yes and yes. If you sell something online, you need to report that gross income, but you can also report the expenses to make that sale and the cost of that item that you purchase. So that all needs to go on your tax return if you do online sales. Okay,
but if I bought a patio furniture set, I'm putting you on the spot. You're going back to patio furniture.
Sure.
And I spent $5,000 to buy it brand new. Clearly, it's a personal use item, so I'm not depreciating it. I'm not doing anything like that. And then I turn around and someone's willing to give me $1,000. I'm happy. Come pick it up. Bring your U-Haul. Take it off my patio. So is that a taxable income event, that $1,000, even though I paid $5,000?
Yeah, so if it's converted, if it's a personal use asset where you've had it and you decide to sell, that is a taxable event. If you're like some e-commerce folks that truly buy the inventory for purpose of selling it, then the cost of their purchase, if it's a business asset or a business purchase, then the cost can be deducted. But there's different rules if it's a personal asset.
Okay. Well, for those that are doing it as a business, don't they also have to get a vendor's license and things like that?
Yes, absolutely. And also make sure to pay, in Ohio, pay sales tax.
Right. And they're not an easy group to get away from.
No. So you always want to pay your taxes, death and taxes. Yeah. So the state is very aggressive and very strict about if you sell something, you need to basically charge the buyer sales tax and file a monthly report with the state of Ohio and pay the tax.
That's if you're an ongoing operating vendor business, right?
Correct.
The individual that's selling there on Facebook Marketplace doesn't have to really worry about that.
They still should be charging tax.
Wow.
Yeah.
Okay.
Yeah, they still should be charging tax on that. And states, not just Ohio, are actually getting more strict about that as e-commerce has expanded.
Okay. Wow. That's good to know. I got to watch. All right, great. Well, hey, anything else before we wrap up today?
Yeah, so I wanted to talk about some of the common misunderstandings or
the stage is yours.
or misinformation about the tax law changes.
All right,
so I just want to tell everyone to be careful what you read online or what you watch on YouTube or what your uncle with an strong opinion tells you.
Yeah.
Tax law changes and a lot of the stuff online is outdated or doesn't apply to your specific situation or is just wrong.
All right.
So one of the common misunderstandings about the new tax law is it made changes to the taxability of Social Security. It did not.
Okay.
So this is something that was talked about a lot in the legislative process before the bill was finalized and passed. And President Trump talked about on the campaign trail. The big, beautiful bill did not change the taxability of Social Security.
Okay, great.
So that's a common misunderstanding about this. Also, what we're talking about today, it really, depending on your income, some of these additional credits and deductions are limited or reduced or eliminated depending on people's income.
Right.
So there's a lot of opportunities here for tax planning and people to reduce their taxes and incentivize certain things. But please talk to your finance and tax professionals to see if it applies to your specific situation. It may not, depending on how much money people make.
Right. So basically what you're saying, the more you make, you run the risk of you're not going to benefit from some of this stuff. You know, the idea here is, again, a lot of these tax changes outside of the business tax changes really are focused on what I consider the middle class and lower income when you look at it, because when you actually examine the bill and look at the phase outs, people that are making significant money are not going to benefit. Their life doesn't change.
Right. And another one I want to add that there's a lot of questions on and misunderstanding about, and it is something that is underutilized, is deductions to charity.
Okay.
So I get a lot of questions about this. With the new tax law, even if you don't itemize, you don't have enough activity to qualify for your total itemized transactions to be higher than the standard deduction, there's a new change that you can still deduct up to $1,000 to a qualified charity or charities and still get that tax deduction even if you don't itemize. So a lot of people do give a few $100s or a few $1,000 to their church or a charity or a local nonprofit. It has to be a qualified
501c3.
It has to be a 501c3 or a qualified charitable nonprofit. And a lot of people may not remember to keep the documentation or put on their tax return or tell their preparer. So that I could see, we don't want people to miss that opportunity.
So you don't itemize, so that's all left blank. But is there, we haven't gotten the new forms yet, but is there probably going to be another line that says, hey, if you don't itemize, but you had charitable contributions to a 501c3 up to $1,000, that'll come off your adjusted gross income?
Correct. There'll be an opportunity for that in the new form. Yeah. And to touch a note on that is the IRS has announced that they are not going to start taking tax returns till mid-February. So it's going to be 2 or 3 weeks delayed.
Wow.
However, I would encourage people not to wait.
Yeah.
You can still get your return prepared, or if you're self-prepare, work on it and just wait till the filing season opens before they file. I really strongly encourage people to file early.
Yeah.
And that also gives you more time to plan, to pay, but it also reduces the amount of opportunity for identity theft and for folks to commit fraud and steal other people's tax returns.
Right. Well, that's a big deal. I mean, one of the things we encourage people to do is to make their payments on the IRS government website versus putting checks in the mail. I know in the Northeast Ohio area, there was a case where somehow my understanding was an individual got copies of the mailman's keys that open up all the mailboxes, and they know there's a big rush to file tax returns, and what they were doing was going in, taking payments to the IRS, taking the checks out and trying to kite the check and convert it and cash it and take the money. So, trying to I know people don't like to usually do things online, and older individuals tend to not want to do things online and do the traditional way, but writing checks. But that's just another risk. The most safe and secure way is to go on the government website and set up your account. It's no different than when you set up your Social Security account to obtain your Social Security statement and to make your payments directly on the IRS site. Same thing with your estimated payments. It really avoids the issues that we were seeing being reported in regards to having your payments taken.
Absolutely. And the IRS have put more protections in place that when you do that, they verify your identity.
Yeah.
Another thing I want to quickly mention is if you've been a victim of identity theft or tax fraud in some manner, which is increasing, you can request from the IRS an IP PIN. It's a 6-digit code that changes every year.
Okay.
That's another level of protection that needs to be included when your tax return is filed. So
Okay.
I'm a proponent of an IP PIN.
Okay, great. And that's something they can talk to their professional about obtaining?
Absolutely. You talk to your tax professional, and you can also get it directly from the IRS. It changes every year. It's another level of security because there's been so much of an increase in identity theft and fraud and stealing of refunds, things of that nature.
Yeah.
It's a real problem, increasing every year.
Yeah, we're seeing, and we're going to do another episode on just fraud and how people are, especially now with the advances of AI, the things that are happening to clients. We're seeing an increase of people, getting subject to identity theft, fraud, and it's just way on the increase, and the government agencies are trying to head it off, but they just don't have all the manpower when you think about the business opportunity to steal other people's identity and money. I did want to circle back. One of the things I think people forget, and it's not part of the discussion today directly, but you raised charitable giving, which I think a lot of people do. A really good planning opportunity is doing what they call a QCD, a qualified charitable distribution, out of their IRA. So some people can't itemize it all, but they can, and it's not when you start taking your RMDs, because now RMDs have gotten, required minimum distributions have gotten pushed out depending on your age to 73, 74, 75. But still at 70 and a half, you can take monies out of your IRA and make a contribution directly to a 501c, a qualified charity. And even though you don't itemize, that money comes off the top. It doesn't get reported on your 1099 when you receive your IRA distribution. So it's a very effective way for people to impact their charity and have Uncle Sam underwrite part of it based on your marginal tax bracket.
Yeah, great point. That's a very powerful tool to be very generous.
Yeah.
That taxpayers can take advantage of.
Cool. Well, thanks. Anything else?
Another big change in Ohio for small businesses is there's a thing called the CAT tax, commercial activity tax.
Okay.
So if they sell things or income is flowed through their business due to sales,
Yeah.
In the past they would have to pay $150 standard fee plus a small percentage of this activity, the state of Ohio. This was very unpopular.
Yeah.
Now that has been raised in Ohio, that if they have gross income from these sales less than $6 million a year,
Okay.
they do not have to pay and file the CAT tax.
Okay.
That's going to be very popular for small businesses.
Oh, yeah. It's like a nuisance tax.
Yes.
Yeah. We always hear complaints, and then people didn't know how to comply with it. And there was more problem trying to comply with it than even paying the tax, which was, added to the nuisance of the whole thing.
Yep, absolutely.
Well, thanks. I really appreciate you being available today. I think we covered a lot of great detail for our listeners and viewers. you really help make sense out of the big, beautiful bill. It's a massive change. It's a positive change. I think we can't emphasize enough to talk to your professionals to make sure that you're understanding what can apply and what can't apply to you, so you can jump on the wagon right now, because it's in effect for 2025. To the listeners, thanks for joining us on Frank Wealth Insights. We put out a new episode each month covering topics in wealth, management, retirement, tax planning, and more. You can find us on YouTube, Apple Podcasts, Spotify, or whatever you get your podcasts. And please follow us on LinkedIn, Facebook, and X for ongoing updates. Until next time, please keep your finances aligned with your values and purpose. Remember, proactive planning beats reactive scrambling every time. Thank you.